Hello everyone, this is Juan Sarmiento and today is Friday, April the 28th. In order to do the cover call, we need to essentially customize our platform for different features that I'm going to be using from here on, and assuming that you are familiar with it and that you have accommodated your platform to follow my trading. If some issue comes up that I need to illustrate to you clearly and repeatedly, please refer to these shorts in my Put Code Genie website. Okay? This is the YouTube channel. So be sure to check all these videos and that you customized your platform accordingly. That's sort of important, okay? Now let's move on to today's video, which is the third in this series. We discussed about two possible accounts that we could create. One, an IRA account that needs to have $100,000 because we are going to trade at least 10 cover calls at a time, and the other, a margin account in which we could simply trade trade the same number of stocks for half the price. That is in margin. A margin account allows you to invest half of your money in a stock. Okay. I discussed the use of the implied volatility, so make sure you check that last video that I just published. And here we're going to see what stocks do we have that we could trade based on high implied volatility. You can see the chart I have created also based on what I have described until now. I am going to trade cover calls that interest me because my idea is to look into the future and keep these stocks and their options month after month after month. So you don't want to trade something that you believe will be out of business in 2 months. That's not at all what we want. We want interesting stocks and that we will be staying with them. Okay. So be sure you select them carefully. Also, if you think that a stock is going to go through the roof, let's say an Amazon or an Apple, you think they're going to keep on going higher and higher, consider keeping them as stocks holding in a separate account. Okay? Because the cover call is not, I repeat, is not for appreciation of stocks, it's for the use of the implied volatility as a source of income for you. Okay, let's start. I want to look here. I have included the Nasdaq 100. You can go through the list. Don't go too low on the list of implied volatility because it can get really low. Let's say PEP here. That's PepsiCo, and the implied volatility is way too low. So you're not going to get much money out of that. Here, Paychex is sort of middle of the road, but it's at the lower end of the implied volatility. Do you see the chart here? It's right now very near the bottom of the chart. So we don't want that. We want sort of higher. Microsoft is a stock that is going really, really high. We don't want that because with the stock going high, the volatility is going to be low. And what we're doing when we're selling calls is we're selling high volatility. High volatility means that that option is right now expensive. Okay, keep that in mind. It's what it tells us, that that option has a lot of meat to it, a lot of extrinsic value. We will talk about that in a minute. So make sure you get up here or higher. Let's say PANW, that's Palo Alto Networks, and here in this case it is, although it's a fairly high volatility at 39%, I see that it's yellow here. The volatility is sort of at the bottom of the range, so no, I'm not going to trade that one. We need to go a little higher, make sure that the chart is on the red, and better here than down here. So when a stock is collapsing, that's a good time. Of course, that means, are you willing to put your money into a stock that is really going down? I'd say you need to trust or you need to believe that the stock would eventually come up. Okay, let's look at Baidu, for example. Baidu, it is a little high, and look, the volatility is high, although it is at the bottom of the range, still red. That means it is a high volatility stock. The problem with this is that it's a little over $100. Remember, because we want to enter 10 stocks with their implied volatility, with the covered calls, the resulting price should be about 10,000 or less. Okay, so what we're going to do is make sure that it fits our need. And this stock trading at 119 is probably too high. If you take a look at the implied volatility, let's say we wanted to enter this. I have selected my layout according to my short video, so make sure that you get that. And I would sell the 28 days to expiration or 35 days to expiration. And I would say, you see the extrinsic value. The extrinsic value is essentially the value that will go away. That's free money for us trading covered calls. Okay, so I see here that at 100, the 120 call has extrinsic value 6.5. That's $650 that I get right off the bat. So let's say I wanted to trade that. Buy, analyze SPY trade, cover call, cover stock, and here it is. Unfortunately, as you can see, is one share, one call, 100 shares will cost me $112.53 times 100, so it's $11,260. So that is a little expensive, even though I'm choosing a very good option here with a lot of extrinsic value. It's not going to work for us. Let's look at other things here. I was looking at let's see where it was, Marvel here. Okay, take a look at the chart. Okay, as you can see, the stock has been going up and down, up and down, up and down. Well, that will work for us because we're trading covered calls, and the volatility is pretty high at 51. Okay, let's go to the trade tab. What is the price of the stock? Well, 40. Okay, so we can definitely afford that one. So let's trade that and choose our option. Which option we're gonna sell? It could be the May 26th or June the 2nd. May 26th is below 30. June 35 a little more. Keep in mind that the decline of an option value is fastest in the last 30 days to expiration. So either one of these two are close enough. Okay. However, this one here has a little more of a more extrinsic value of $2.39. A little more, not a whole lot. So let's compare them. Right click and say buy, cover stock, and do the same with this one here. You see that this the out of the money that gives you the most extrinsic value. Buy, cover stock. And do this one as well. Cover stock. Then we can compare the two of them. Look at the risk graphs. All right. So you can see that this one here, the May 26th, cost me a little more. Why? Because the option of the extrinsic value of the option is a little less. Okay, so I say, well, let's do the June the 2nd. All right. Now, how much is this going to cost me? $3,653. What if you did 3 of these? Create duplicate, confirm and send. Is that more than $10,000? Yeah, it's a little much. So we can do 2 of them. And don't worry about not spending all the money that you could spend, because that if we can trade 11, it's 11 options, 11 covered calls is better than 10, okay? Because it's more variability. And there it is, okay? Let's send that off. And look at that. This is already filled. This is our margin account, and look how it's subtracted. It didn't subtract 7,000. It's subtracted 3,500. Okay, why? Because it is in margin. So we are actually can invest the same way, but in the IRA account we can't do that. We have to put the entire money. Okay, how about we did the exact same trade? Let's keep it in parallel. Let's keep it in parallel. So let's say create duplicate, the exact same price, and then confirm and send, and make sure that you choose the right account, which is the IRA account. And yeah, the buying power effect is 7,360. The buying power effect of the other was 3,500. Okay, so let's send that off. And that is our first cover call. Let's leave it there and see if it fills. There, they both filled. Now you can say all accounts and see how we progress in terms of gain. As we go along, I will show you when and how to make the rollover. What the rollover means is you close the existing call and sell the next month up, keeping your shares of stock. Now, if you think about it, you might say, well, what if the stock collapses? Well, if the stock collapses, you would hope that it will go back up eventually. It doesn't matter. If it stays in a steady location, what is going to happen is that the value of the stock will fluctuate, but every month we're going to get our payoff. Now, how much did we get for payoff? Well, consider that the calls will, most of its value is, or all of its value is extrinsic. Remember this, we have the June 23rd, 39. Most of all of the value, you can see the intrinsic value, the extrinsic value, and you can look at the intrinsic value as well if you want. Let's add that up, okay? Let's say customize and say intrinsic. We want to know how much is the intrinsic value. I don't really have to put that. I know that if the stock is out of the money, meaning the option is out of the money, if the option is higher than the current stock price. The current stock price is not 39, not yet. So when I enter the trade, that intrinsic value was 0. The extrinsic value was $2.18 for the May 26, but you entered the June, so this was $2.49. That means we're getting $2.49 times 2 because we have 200 shares. Okay? That means that for this little trade, if you look at the calculator, we invested how much? $10,000 or less. In this case, we invested 7,000. Let's see, 3653 times 200, 7,300. Let's say that. Okay. Now, how much are we expecting to make out of this trade? Where we hopefully we will end up with that option being worthless, regardless of whether the stock goes up or down. This option, this extrinsic value will be 0. That means I have the guarantee that this option that I got, which was let's see, how much was it? Well, you can look at it here. The price, the strike price is 39 minus what I pay, 36.53, $247. That's how much I got as extrinsic value. Multiply that times 200, that's almost $500. I'm gonna get Hopefully, I'm not saying it's a done deal, but it's hopefully you get the same kind of income from a month to month. So you can multiply that times 12, and that you get $5,228 for every month if you repeat the process of selling those 2 calls every single month. Okay. Now, if you divide that by the investment, multiply, that's 8%, 81%. It's ridiculous, 81%. It doesn't matter. I'm sure it's not going to be exactly that, but it's certainly better than 5%. It will certainly be better than 5% that you're going to get on a CD. It doesn't mean take your money out of your CDs and put it into this, but it's sure good to know that this is a potential. Now, the stock itself, the assumption is that sooner, let's say in a year from now, this Marvel will be more or less the same price. It could be higher, it could be lower. If the stock goes up, it's going to be more difficult to get that extrinsic value. But I'm going to show you the best possible scenario, the best way you can to assure that you get this kind of extrinsic value. That's our purpose. Never mind owning the stock, okay? You can own stocks in a separate account. All right. Let's see if there is any other that interests me. Remember, it needs to be below $100, or let's say 103, 104. And so look at any of these you recognize. Would you like to trade any of these stocks simply because, well, this is, for example, is out of the question. The Baidu already determined that it was out of the question. Nvidia is too high. Yeah. What about PYPL? Let's take a look at that. I think it's PayPal. There you go. PayPal is moving sideways. Look at that. Earnings are coming up. So what is going to happen at earnings? The stock can collapse or go up. Give yourself some time to make this thing work. Okay, it's just too close to the earnings. I was considering yesterday Intel, and the volatility already fell. As the stock jumped, volatility collapsed. Yeah, the stock going up, it would have complicated matters, my next trade up. Okay, so yeah, we can avoid those. Look for stocks that are better for us in that sense. Okay, so PayPal, we said, is too close to earnings. NetEase, okay, that's a good one. Volatilities, well, it's at the bottom of the range, really, of its range. 42, and the stock has been moving sideways, so that's sort of what we want to trade. Okay, Qualcomm is a little too high, and now we're moving into the volatility being low, so I'm going, NetEase is a little too low. Okay, and that's about it. Now, this is the Nasdaq 100. You can choose any list. It could be your favorites list. I have one here that says candidates. Okay, here again we can look at them. This is United States Steel. This looks actually good for that if you're interested in the United States Steel. I'm not, so I'm gonna pass. Apache. Now this is interesting to me. Volatility 48 is a little high, which is good, and the stock is bottoming out. I think I want to trade. Well, options are earnings are coming up, so I'm going to avoid that. Apple, of course, is too much money right now. We want to sort of a certain range. MU, that's Micron. No, I don't like it. Okay, I'm gonna keep looking, but you can certainly choose any public list. How about we choose the S&P 500? Come over on public and you can see the list. And there's the NASDAQ 100. And you can choose, I would say choose some stocks that are well known, because you don't want the stock to go to zero, because then you lose all your capital. That's not what this is about. We want to preserve our capital. And here we have the S&P 500 and it's sorted out. Now we can see some good candidates in terms of high volatility. For example, Expedia. Is that something I want to trade? No, earnings are coming up. We are in earnings season, so we have to watch out for that. Apache, this is too high. Okay, so we will save some for next week, okay? But that's the general idea. So make sure you check those short videos. I will enter more stuff of interest on setting up the platform and things that are repetitive, so you're aware. Okay, so I'm going to discuss the Greeks like Delta, Vega, and so on in my shorts, because these are things that you are constantly using that you need to know and keep in mind. Okay, that's all for today. Thank you very much for joining me, and see you next time. Bye bye.